businesses, the corporations. So let's take some, okay, for 2018. You'll notice on slide 33, I've got 5 bullet points. We got new rates. We got these foreign profits that are coming back in the United States, which is unbelievable what we've got there. They've changed a lot of deductions. Matter of fact, many of you are accountants. Would you believe they're changing the accounting methods now on our tax returns? And this affects, the 2018 tax returns. So let's go ahead and take a few minutes and go through each one of these slowly so we can understand. First, the corporate rates. You'll take a look and you'll notice that prior to 2018, our corporate tax, and by the way, when I say corporation, I'm talking about a C corporation, not a sub S, not a flow-through. These are corporations, C corporations, okay? Which, by the way, would you believe even the Wall Street Journal came out with an article saying companies ought to look at, privately held small companies should look at converting to C corporations. Here's why, one of the major reasons. On the left, you're going to see what our corporate rates were. On the right, you're going to see what it is now. In 2018, all corporations will pay a flat tax of 21%. Now, be careful. If you've got corporations, flow-through corporations that are showing a profit of under $50,000, remember, if they were C corporations, they were paying taxes of 15%. Their taxes are going up to 21%. They're having a 6% increase in taxes. So any of those little small private corporations that were C corporations, or even flow-throughs, you don't want to convert them over. And if they were C corporations and their profits not expected to be over $50,000, you might want to convert them to C corporations. To S corporations, subchapter S, because if they stay C corporations, their tax rates go from 15 to 21%. But if their profits are anything over $50,000, now or expected in the future, notice the tax rates were 25%, 34%, 35%, now it's 21%. Tremendous savings, people. Tremendous savings. Not only that, but there's other benefits to a C corporation. And just quickly, you see that flat rate of 21%? That flat rate is on all profits, including goodwill. Normally, you would have goodwill or capital gains that doesn't apply to C corporations. So you'd have a capital gain tax of individuals, which are 20% or 23.8% because of the Medicare tax add-on. That does not apply to C corporations. C corporations and capital gains will only pay 21% on anything, whether it's goodwill or what have you. They will pay a flat rate. They're paying less taxes than personal corporations now. Major reason for considering corporations. Okay? Very, very important for you to take a look at that. Let's see if we can't keep going. There's so much more on this. In the pass-through entities, I've mentioned this before, but I want to make sure you are aware of this. And I put it in highlights on slide 35. 20% deduction for qualified business income. What is qualified business income? It's only income generated for the purpose of the business. Okay? You got to be very careful. It excludes, by the way, health, law, and some professional services. Okay? And it obviously includes anything else. And publicly traded partnerships don't qualify for this. Oh, by the way, this does not apply to any real estate investment trust as well. So please be careful of that. All right? You've got to be very, very careful. And remember what I mentioned to you. Flow-through entities, the effective tax rate is approximately 29.6%, not 21%, because they're not like, again, going back to slide 34, they're not like a corporation with a flat rate of 21%. So the pass-through entities, even if they have a 20% deduction for qualified business income, their effective tax rate is going to be 29.6. Plus, they're still subject to capital gains and Medicare tax of 3.8% on top of the 20%. So we have that situation. Okay? Now, a couple of other things that you got to be aware of these. Okay? A lot of corporations show losses, and they've always been able to take the losses. And if they're passed through, one of the reasons that we have pass-through entities is not because of the profits. For example, a lot of real estate companies set up as LLCs and as partnerships or subchapter S's, so losses generated basically through depreciation law can be deducted on their personal returns. For 2018, look at the second bullet point on slide number 36. It's disallowing Any losses in excess of $500,000 for joint returns and $250,000 for all others. So if you've got a client who is showing a loss, and that client is filing an individual tax return, and they've got a sub-S or a partnership, they cannot take a loss. They can't deduct it if it exceeds $250,000 in 2018. Now, they don't lose it. They can carry it forward. And by the way, just to let you know, and I'll get into this later, but I want to point it out now, you can't go back any longer and file amended tax returns for prior years and apply current losses to prior years. They've eliminated that law. It's going to hurt a tremendous amount of companies that made a profit in the past and pay taxes, and then in 2018 show a loss, and they'd like to take the loss and go back to 2017, 2016 and get a refund back. The government will no longer give you refunds for taking losses backwards. Losses now can only be carried forward. Okay? Many companies have complained. Many companies have said, as a matter of fact, even financial institutions said, my goodness, this is going to hurt us because our clients are not going to be able to take a loss carryback, and as a result of not taking a loss carryback, they're not going to be able to get a refund. They're not going to have that extra cash to run that company or to pay their bills. Okay? So please be aware of that. The third bullet point is charitable contributions, foreign taxes, taken into account when determining limitation on the allowance for the partner's share. So this is also limiting things. Okay? So please be aware there's been some major changes with regard to partnerships in subchapter S's, but basically partnerships with regard to their interest. And by the way, the technical termination rules, when I said it's been repealed, there's been a big argument about that. Okay? Because people have said that they've had to hold assets for 3 years in order to qualify for capital gains treatment. And there's been a big argument whether that's valid or legal or not. Anyway, that's all been terminated. Okay? To just take it out. All right? Remember that partnership return is a 1065 tax return. Okay? There's a lot more there. There's so much going on in this tax law. As a matter of fact, when the slide number 37 was made, I said, there's too much writing on the slide. I don't like so much writing, but this is so important. There's been so many articles written that a lot of subchapter S corporations should now be converted to C corporations for 3 reasons. First of all, the tax rate. Even with a 20% deduction on earned income for sub-S, the effective rate is still 29.6% versus 21% flat rate for corporations. 2, C corporations stand on their own legally. If a C corporation is audited, there's no justification for a sub-S, or excuse me, for the personal return to be audited. On one case I was involved with a CPA corporation that hired me, CPA company hired me, because one of their clients had a sub-S, and the inventory methodology was questioned by the IRS, so they slapped the personal owner on his personal return, and we put a lien against his home, took his boat off of Lake Michigan, froze his bank account. Because in a sub-S or a partnership in many cases, what happens? Because they're flowed through entities, legally, the personal returns are critical for the tax, and they're responsible for the taxes of the business. So if the inventory method in a sub-S corporation is improper, in question, and there's a tax, the tax is applied to the individual. That's not true with a C corporation. So aside from the flat tax, you also have a liability potential problem where C corporations are separate and distinct from the owners. And therefore, if a C corporation has a problem with inventory or anything else, they can't touch the personal assets of the owners. They can only go after the assets of the corporation. Supreme Court has clearly said C corporations are artificial persons in the United States and are separate and distinct from the owners. Okay? And there's a third reason. The third reason is because corporations have certain tax deductions that are not allowed. For example, if there's a corporation that has real estate, there's no limit on the amount of interest that can be deducted on mortgages. There's no limit on the amount of taxes that can be deducted. Okay, where there is on individuals. And as far as double taxation is concerned, I've yet to see a private corporation issue dividends. Okay? Dividends are typically issued by public corporations. So the double taxation rule really doesn't apply unless you have passive investors in a C corporation and they want dividends.
Right.
So it applies only for private corporations that have passive investors or for publicly held corporations. Okay? So this slide 37 becomes critical. In 2018, many sub-S corporations are converting to C corporations. So what's the tax law said? Because the tax law, Congress knew, the writers of the 2018 tax law were well aware that when they passed this law, they were encouraging subchapter S corporations that made over $50,000 in profit to convert to C corporations. So here's what they did. Take a look at these bullet points in 37. Obviously, it modifies treatment. Second bullet point. Prior to the new tax, this is the old law, an S corporation that converted to a C corporation had distributions of cash by the C corporation from earnings of the sub-S. And remember, the sub-S profits were taxed when they were earned. So if money was distributed out of the C corporation after it was converted from an S to a C, there were no taxes on it. They've changed the law. Under the new law, look at the last bullet point on slide 37. Under the new law, okay, adjustment on an eligible terminated S corporation attributable to the revocation of the S corporation election. A change from cash method to accrual method is taken into account ratably during 6-year time period, beginning with the year of change. Wow. Here's what I recommend that you work with your clients. If you have clients who are sub-S's and they want to convert to a C after you sit down and talk to them about the benefits, the pros, and the cons, if there's any retained earnings, any previously taxed income in a sub-S, distribute those funds out, whether they're money or whether they're property, to the stockholders before it's converted. Then it's converted over to C corporation. If the C corporation needs that money, loan it back. You've got to have a qualified, corporate resolution, a loan document, a repayment schedule, interest. Okay? So that you have an actual transaction before the conversion and after the conversion. Separate from that, then watch and see whether the cash method is allowed, because they've changed the accounting. And they said if the gross receipts, and I'll get into that a little later, are less than a certain amount, your C corporation can now use a cash method of accounting instead of accrual method, which again changes the reporting of the income. Receivables will no longer be reported as income if they're on the cash basis until they receive the cash. Okay? Also, anyway, there's several changes. I'm going to get into that differential between cash and accrual on when they get it. But be aware, Congress was well aware of a conversion of S corporations to C corporations. Okay. Let's talk about foreign profits. This has been tried before by other presidents. Many corporations in the United States have foreign entities, and they make profits in the foreign entities because the foreign entities manufacture the product, sell it to the United States corporation. The United States corporation sells the product, doesn't make much profit. The profits are retained in the foreign corporation, and the foreign corporation has all this money. Okay? If the U.S. corporation wanted it, they borrow it from it. Let me give an example without mentioning names of companies. Okay, we also have what is called transfer pricing problem. Let's assume a company in the United States manufactures a product for $10 and they sell it wholesale for $30. So they make a $20 profit on their manufacturing. That $20 profit is taxed in the United States. The company, the United States corporation, does not want to pay taxes. So they set up a manufacturing plant in another country. I'm not going to identify countries. Let's just say a foreign country that has a lot lower income tax. They manufacture it in the foreign country. Now, while it cost them $10 to manufacture it in the United States, and they sold it for $30 to their distributors and made a $20 profit, in the foreign country, let's say they manufacture for $8. They save a couple of dollars because the labor is cheap. Okay? Basic concept. Do you think they sell it to the U.S., transfer it to the U.S. corporation for $8? No. They sell it to the U.S. corporation for $30. $22 profit is kept in the foreign corporation. The U.S. corporation now has the product that cost them $30. They sell it to the distributors for $30. They show no profit on the sale of the product. They pay no U.S. income taxes. In the meantime, $22 is sitting in a bank account in a foreign country. Let's make it simple. They pay $2 in foreign taxes. They have $20 in a foreign bank. If they brought that $20 back into the United States as income, they would have to pay taxes on the $20, would defeat the entire purpose. Now, we call this transfer pricing. And there's laws against transfer pricing in the United States, but they're very easily get around it and very difficult to enforce. The key is that this $20 is sitting there. Prior presidents have tried to say, we want that money brought back. And they've given people, companies, incentives to bring them back, bring that money back, in the hopes that they would build more plants here, manufacture more products, give higher wages to their employees. It hasn't worked. Here's what Congress has now tried to do. Starting in January of 2018, one time, you can bring in your foreign profits. If you bring in that $20 to the United States, you don't have to pay taxes. And by the way, their taxes now would be taxed at 21%, corporation tax rate. We'll lower that to 15.5%. I don't know if that's a lot of incentive. That's a savings of 5.5%. No, 5%, excuse me, yeah, 4.5 for that. Anyway, from 21%, okay? It's not that much of a savings, but yet on a large billion dollar cash out there, it does. But here's what they did, something even worse than that. They got that $20 sitting. They said, if you invest that $20 in a foreign country, like a plant or equipment, and you bring the investment back, so you bring the ownership of the stock back of that foreign corporation, we'll only allow you to pay taxes at 8%. Oh my goodness. What company would bring the cash back? What company would bring the investment back? Why pay 15.5% if you can get away with paying 8%? Now, some companies have publicized the fact that they're bringing money back. The question is, when they bring the money back, what are they going to do with the cash? Well, we have found that some companies are giving their employees a little bit of money as a bonus, but most of the money is being used for two purposes: to give dividends to their stockholders or to buy back their stock on the stock market. So the benefits are not going to be enjoyed by workers. They're not bringing the plant back. They're not bringing the investment bank back as far as making the products in the United States. Not only that, but you want to know the interesting thing about this law, okay, that I found very, very interesting. It's a one-time transition tax, right? Would you believe they have 8 years to pay it without interest? So they can bring all the money back in 2018, which will affect the 2018 tax returns. And you may have clients that do that. I've got one privately held company that I assisted in Indiana that have a manufacturing plant in China. And they had so many sales, they stopped manufacturing because they couldn't handle so many sales in 1 year. It's amazing. So this can help. This affects private companies too that manufacture in foreign countries. Okay, that have set up foreign corporations to structure it. Okay, they have 8 years in which to pay this. It's just imagine. It says the Jobs Cuts and Job Act deemed repatriation of currently deferred foreign profits and cash equivalent profits at 8% can be paid over an 8-year period. Not only that, but if the U.S. corporation had credits due from alternative minimum tax, or they had credits due from overpaying tax in the past, they can apply their credits to this 15.5 or 8% tax and lower it. So I want you to be aware that this law became effective in 2018 and can affect some of your clients if they have foreign operations.
Okay, you guys, so I'm going to just go ahead and move on to the next video, and I'll go ahead and upload the circular, finish uploading the circular to 2:30. So if you have any questions, just reach out to me and we'll just go from there.